All right, everybody. Sunday, August 24th. This is the continuation of the sleepover extravaganza trades. So in this video, I'm going to show how we can potentially boost up that lower edge and get it up towards closer to break even or even into profit. So if you're confused as what I'm talking about, I am too. No, I'm just kidding. But let me just build one here out, and then I'll show you what I'm talking about. So it's just let's go to this is a Sunday, so let's just build out one of these sleepover trades as if it was Friday at market close. So let's go to the right option chain here, August 25th. That's tomorrow. These are trades we put on at the end of day market, and then for the following day, 0 DTE options for the following day. And best case scenario, or the goal, the ideal situation is that we wake up into a profit. These things pop into profit right at the open. So let's build one out of these as we would at the end of the market, and let's do it on the put side. I basically start these off just by looking for a delta of around 16 or so, and I'll say analyze buy, then I'll say unbalanced, and then I'll say condor, and it throws this default condor in there. Just take a look at it. That's the default condor. It's a very narrow one, and I just start to stretch these legs out till I find the trade that I want. So I already went over all this in the video one on this series, but let's just go through it again real quick as I build this out. So what I'm trying to do is I'm trying to get the far edge of this condor. This is the 2-leg side. The side with the more risk. I want to stretch this out as close as I can to this 1 standard deviation line. And so let me just change these strikes. Let's just go down by 10. Stretch them out. Stretching out the wings. Let's go like 5 more points. Okay, that's pretty close. And maybe we can get closer, but I'm going to pull this side out now. So I'm trying to balance. It's a balancing act between trying to get as close on this side to the 1 standard deviation away line, and on this side as close as I can to the at the money where the SPX is trading right now. Well, so far anyway, I haven't ever gotten to it, but I'm looking to get like 10 to 20 points away from it. The closer the better. The closer to both of these sides the better, but I'm trying to get a debit as cheap as I can. The cheaper you can get these, break even or a credit is the best, but I've never seen one with the width that I want for a credit right off the bat. Close to break even, but usually they're like 40, 50, 60 cents or more, sometimes up to about, I don't want to pay more than $1 for sure, and that's expensive. Ideally, I want to try to get these for around $30, $40, $50, somewhere in there, or less. Debit. So I'm going to stretch this leg out now towards where the SPX is currently trading at, so let me just move these strikes up. I'll start with 10. Let's see. So that's a little bit wider. I like to try to get this tent 30 to 40 points wide. So right now it is 10, 20, it's 30 points. And it's saying we can do it for a debit of 40. Let me see if I can pull these wings out a little further, closer to where the SPX is trading. Okay, so that's about 15 points away from where the SPX is trading right now. This is saying I can do it for a debit of 45, so that's pretty good. And now I'm going to see if I can pull this wing out to encompass or get over this 1 standard deviation dotted line there. So I'm going to move this down by 5 more points. Okay, so this thing we can do for a debit of 65, which is not too shabby. It's not great. Again, I like to try to get these 50 cents or under. But let's take a look at it. So how wide is this now? So this is 10, 20, 30, that's 40 points wide. So that's 40 points. Well, the wider the better, but to fit within these parameters, it's usually a structure that looks like this, for about 30 to 40 points wide, debit of like 30, 40, 50, 60 cents. This is 65 right now. And we want to get as close as we can to the 1 standard deviation line on the downside, give us plenty of room if there's a move down the next morning or overnight, and 10 to 20 points away from the current trade of the current price of the SPX. This is 15 points away. So let's start with this. And so this is a 1 contract trade. So in this video, what I'm going to be talking about is how can we get rid of this risk here. This is showing a risk of the debit, which is 65. So from here all the way up to the moon, if it expires there, not trades, it can trade in this area here throughout the next day and still be profitable because of the way this pink line rises up. Like right now you can see that and see how it's rising. That continues to do that throughout the next day, and it gets bigger and bigger and bigger until it turns into this tent. But just as a fail-safe, how can we try to get this risk here, this $65 worth of risk, closer to break even or profitable without throwing the whole thing off? One way we could do that is by stretching out this wing longer, but that's going to give us more risk. But let's just take a look at that. So, well, there's a couple ways we do it. First of all, let's just pull this leg out. Instead of a 10-point wide spread, let's look at a 15-point wide spread on the downside. So that would be, we would change this to 63.95. Okay, so we've increased the risk now. We've just widened that leg. So before there was about $1,000 worth of risk. Oh, there wasn't even that. Look at that. There was $565 worth of risk with the first version here, where we have this $65 total end of day risk ledge. So, and that's with a 5-point spread. That's 5 point. There's two of them. So 5 points between these two strikes. So if we widen that out to 10 points, now it's 10 points wide, you can see that we've increased the risk to 1,500. Worst case scenario. Worst case scenario on the downside. And we've raised that line up now to, so now there's only $20 worth of risk. So just by increasing the risk on this side, we've boosted up that worst case scenario up here. There's still risk. There's $20 of risk, but that's far less than the 65. And this line here will boost probably quicker the following day. It'll boost up faster, but you can see it really falls off here much more steeply, and there's a lot more risk on the downside. So I'm just going to throw out all the ways that I know how to raise this pink, this line up, this blue hard line on the upside, and then you can choose whatever tickles your fancy. You can use. Well, sometimes I'll do this, but I'll have a hedge in place. It's just playing around with the strikes and the hedges and all that to try to find the medium that works the best, the happy medium. So that's one way to do it. Let's see another way. Let's take this back to where it was. Okay, that's where the original trade was. You can see this pink line, how it really gives us a lot of power here, money power in this tent. It doesn't fall off till that way down here past the 1 standard deviation line, which is why I like this kind of a setup. With the one we just looked at, you just see how it falls off in the middle of that tent. It really starts to fall off, which is more risky on a down move. Let's go back to where we were. So that's one thing we do. Another thing we could do, we just stretched the wings out longer. Now this one, let's look at, we could keep the wings the same width, but we can just increase the contracts on this side. So this is 2 contracts and 1. If we were to make this 3, that raises up that line. Not by a lot. Before it was 65. Now you can see that it's raised it up to minus 50. So we chipped $15 off of that. So just a little bit. We still have kind of a good staying power, but not as good as the first one. It still starts to fall off there. And we've increased our risk to 1,000. So those are some ways there you can do that. Let's just change this back. And neither of those ways are the ideal way as far as I'm concerned. I've done it, and I might do it going forward, but I have a different solution that I like better, which I'll show you here. Let's just change this back to the way it was. Okay, here's the original position. Okay, so the more ideal way that I like to do these is I like to buy myself a little bit of a boost right here. And so this is the SPX this trade is on. So what I'll do is I'll come in here and I'll go to the XSP, which is like the SPX just at 1/10 the size. So we'll say XSP. And then I'll look to see where I want to buy it. Well, basically what I'm going to do is I'm just going to buy a little debit spread here, somewhere in here, just to boost this line up or most of this lineup, to try to eliminate that risk, that $65 worth of risk. Try to get that as close as I can to break even, or maybe ideally even to a profit there. So I'm gonna look at the strike where this thing ends at, which is 645 in XSP world, again, which is 1/10 the size of the SPX. And so we're combining the SPX trade with an XSP, which is just like, it's just getting granular on the SPX. It's 1/10 the size of the SPX. Because if I were to try to do this with an let's just take a look at that. If I were to try to do the same thing with an SPX debit spread, at least at this size of 1/2, it would just be overdone. So let's see. So now we're back on the SPX. Let's look at 6450. If I were to buy a debit spread here to try to raise this risk up on the SPX, let's go to 6450. So let's go to the 6450 call. 6450, which is right here. So I would say analyze buy trade, and then it went off screen so you can't see it, but I'm going to say vertical. So there's the vertical at 6450. It would just do that. It's just overdone with one contract, with the original trade being just one contract. So it's just kind of overkill, and it throws the whole thing off. But if this was a bigger contract position, which we'll get into in a minute, say 3x4, or no, 3x6 or 4x8 or 5x10, just kind of making this initial broken wing condor bigger, these can start to come into play. So first I'm just going to say, let's just look at it with just one contract, the smallest size on the SPX we can get, and then how would I hedge that? So I would go over to the XSP, and I would buy a debit spread at 645 to begin with. So let's do that, 645 on the XSP, 645. So I'd say analyze by trade vertical. And as long as you have, on the risk graph, as long as you have this thing set to portfolio beta weighted, you can see what these trades look like mixed with mixed vehicles combined together. So make sure that's on portfolio beta weighted. And then here's the XSP. So let's take a look at, let me get rid of this just so it's not confusing. That's the SPX debit spread we just looked at. That was overkill. So I'm going to delete that. So now all we have is the original 1x2 iron, unbalanced iron condor, or not iron, unbalanced condor, and the XSP hedge. So let's take a look at that. Okay. So if we bought the XSP hedge, this is saying it's going to cost $68. You can see how it does boost it up significantly, or it's by half. You can see that except for this little area here, which we're not worried about, and I'll show you why in a second. It's raised up that line, which was at $65 worth of risk, all the way up. It's raised it up to, now there's only $33 worth of risk. So it cut it in half from here all the way up. Let's take a look at what if we did two of them. So at two of them, we're at -1, so we're basically at break even now, which is cool. It's changed this a little bit because of it falls off a little bit sooner than without it. You can see we have this nice ramp hill going into the tent if we were to move down. So when we do this, it does change that slightly. But what it does is gives us, if the thing were to blast off the next day like it did on Friday, when on the Fed announcement at Jackson Hole, when Powell said something that made the market go nuts and it shot up 100 points, this would have kept us out of a loss if we had this on. This would, well, we would have had $1 loss according to this, which is like, let's just call that break even. So this is a way to boost that thing up. If we did 3, you can see we get into a profit now. We make $31 all the way from here all the way up. But each one of these spreads that we add to boost that line up, we're paying for it on this end. So without it, you can see we started off with a risk to the downside, 565. A total profit potential in here, $435, and the risk of 65. So let's just go back and let's just say if we add one XSP, Now our risk is 633, so it's increased our risk to the downside, which we're with our hedge and everything, we're planning for this not to be a problem. But it does decrease from the profit tent by 3. Now it's 367 potential profit in the tent, where before it was 435. So it's basically just decreasing the profitability in the tent by this 68 bucks that we paid to boost this up, to raise up this total risk here, total potential risk from 65 to 33. Okay. And then of course, so each time we add another one, if we wanted to add another one to make this like $1 or break even, basically, you know, we're bringing down the total profit potential in this tent by another 68 bucks. So now the total profit potential in the tent is 299 bucks, and our risk is a little bit more. Now, something to consider is that the way that I'm playing these, I'm not necessarily expecting to get the total profit potential in the tent. I've taken these all the way to expiration before, but I'd rather not do that, just because if I can just get my quick 50 to 100 bucks on one contract out in the morning, then I just get out of the trade, or I turn it into a levitation trade where I can't lose anything else and I can just only make profit. So that may not be a factor really to be too concerned with, that we're decreasing our total profit potential in the tent. You know, it's still 300 bucks here, where this is 299 with these two spreads on. So it's decreased it some, but that's still a good profit potential, and it still gives us the boost we need for this pink line to do its thing, to raise the magic bow and give us what I'm looking to make, 50 to 100 bucks at least. Okay, so that's one thing we can do. We can do that. We can raise it up. Now let's add in our hedge here, because that's something we're not taking into account. So let's put our hedge on the initial trade. So I'm going to turn off the XSP debit spread for a second. We're only going to look at the main structure here, the unbalanced condor, and let's put our hedge on. So for the hedge, let's go back to SPX. Let's see, where do we want to buy that hedge at? Start at 6,400. 6,400 right here. Okay, so we'll say analyze by trade vertical. So here's the hedge starting right at the same strike as these two longs, which you can do if you want. It's going to cost a little bit more. This hedge here, like tight up against those two longs there with the same long, that's going to cost you 25 bucks. Usually I'm fine with going out a couple strikes. So if we went out by 5 strikes, we'd get it for 15, which is good. Let's take it another 5 and see what we can get. So this saying we can get that hedge for 10, which is pretty dang good. I would probably go with that one. And I've even gone 3 out, but I probably wouldn't do more than that. Well, this is saying that one's 15, so the pricing's a little funky in here. But I have gotten these for 10-15 cents before, so it's not totally unreasonable. So let's go back to this one. Let's just say I was able to get it for 10. So here's the trade without any upside hedge, without any boost to try to boost that line up. Here's the trade. So in this case, now we have a total risk of $75 because we bought that hedge for 10. So worst case scenario, if it expires, not if it trades. If it trades in here, we're still profitable. We can still be profitable. If we just let the thing go to expiration, the worst case scenario is from here all the way up, we lose 75 bucks. And then we have, the same thing here. On this little edge, we have 75 bucks. But then there's this risk here in this whole 575. Okay, but we're not too concerned about that until later in the day, because we have this nice pink bow, magic bow line protecting us, giving us profit. Okay, so there's with the hedge. So now let's take a look at adding this little booster up, what that does with what we have the hedge on. So let's just start with 1. This is that same XSP hedge. We're trying to boost this line up, this ledge here of minimal risk, because just in case there's some sort of a big move, big ripper the next day, like there was on Friday. So let's just take a look at one of them. So if we bought one, you can see it boosted up a little bit. Now we're at minus 43. Again, that's pretty much cut it in half from our 75, which is now the risk because of this hedge we have on. So there's 75 without it of risk. With it, with one, there's 43. And so again, this is decreasing from our profit tent here, but again, we don't necessarily need all this profit unless you want to be hardcore and try to take it all the way to the end of the day, which I wouldn't recommend. I mean, I won't, well, unless I'm totally protected, I wouldn't do that. I'm just trying to get a quick 50, 100, 150 bucks out of this thing the next morning at the open, or as close to at the open as I can. And then either take the trade off or turn it into a levitation trade, or as the on-ramp for my daily look-ma no hands trade. So there's one of them. We've reduced the risk now down to 43. Let's see if we do two. Now we're up closer to break even. Now we're at $11 worst case scenario from here all the way up. So that's not quite break even, but it's pretty dang close. Again, we have some risk in here, but I'm not concerned about it. If you know how this pink line, this pink bow works, the next day this thing is just going to start to raise up, and it's going to be raised up over this. It's not going to dip down into there at all. At least in my experience, I've never seen it until end of day. Like once this thing really starts to, like the last hour, 30 minutes, 15 minutes, when this pink line is trying to convert and turn and transform into this blue line, you know, then it may be raised up like that pretty high, and then it may come down and dip a little bit, and it's not going to totally dip to the bottom of that until end of day. So you can eliminate, there's various ways you can eliminate that risk, which are, you can see in all my other videos, like on the levitation trade, on the look-ma 2.0 and all that. There's tons of different ways to get rid of that risk throughout the day. And certainly at the open, this thing is going to be hovering over it. That's not an issue. So this raises up the worst case scenario to 11 bucks. Let's take a look at three. If we put three on, now we have a trade where we're profitable. So if it lands anywhere from here all the way up, it'll make 21 bucks worst case scenario, 20 bucks profit. And again, we've reduced the total profit potential in this, but I'm not necessarily looking for that total profit potential. I'm looking for a quick 50, 100 to 150 bucks from the pink bow. The pink bow will raise. Now, the higher we get this thing, the more of these we buy. This pink line is not as beautiful as without it. Without it, this thing really raises up quick. So on a move up, we just get into profit really fast. Nice profit because of that magic bow. But with each one of these that we add, it's less pronounced. Like that's not, I mean, that's great. I would take that. I'd definitely take it. But it's not as juicy and as high as without it, without this on, as what we just looked at. With two, it's even less. This is still not bad. We got a little bow going there. And the next day, this bow is going to continue to rise. It's going to grow. Once we get to three, you can see it pretty much flattens out, and it starts to fall off sooner on the down move. Like we get into risk here on a down move with three of these, where on one, we don't get into risk until down here. So it's just a matter of playing with these strikes, kind of trying different variations, building out different ways of building this, and seeing what you're comfortable with. But this is a legit way to eliminate all that risk on the upside. So on a day like Friday, when Powell spoke and it went up $100, you know, we could have let this thing just go and not do anything, and we would have ended the day at the end without doing anything. At expiration at the end of the day, we would have had a $21 profit. So that's how we can raise up that line and potentially eliminate it. Now so that's with the XSP, and I'm using the XSP because I'm only using a one contract original trade. So the Broken Wing Condor, this is only a one contract. It's the smallest size available on the SPX, and that's why I used the XSP. But if we're doing bigger trades on the, if we're doing like multi-contract trades on the SPX, like let's just boost this up to, let's just say 5. So it'd be a 5 by 10. Okay, let's take the hedge off for a second. So this is a 5 by 10 of the exact same trade. You can see with this is showing a potential loss down here of 325. But again, if we stay within a reasonable range at the open, this pink line is going to boost up higher, and that's not going to be an issue unless it takes off to the upside. Usually it's like, from my back testing and from what that guy has, the guy who I learned this from has told me, it's like 20, 30 points maybe. We have at least at the open, we have a buffer zone of 20 to 30 points to the upside where we can pretty reasonably expect to at least break even, still be in profit from the bow or break even. Once it passes 30 points, like if it gaps up over 30 points, which doesn't happen, that was very rare. It does happen, but it's not a common occurrence. Or on a big day where it shoots up 100 points, that's not common either. But if it does that, then that's when we start to have issues with it, as you saw on the trade we did on that Friday, that live. Just look in the training modules, look for a video. It's called live video or live trading 822, I think. Is that right? Yeah, 822. It was the day that Powell spoke and the thing shot up 100 points. Take a look at that and you can see like the worst case scenario on the upside of one of these trades, where we just basically take the full loss, which isn't a huge loss because the way it's built. And in comparison to what you make on these or what you're shooting to make, it's totally in line. It's like about the same, depending on your profit target. Like say let's just take this back for a second. I should probably do a whole video on this, on just the profit targets and like what I'm looking to make and risk in reality with management. But so here's a one contract. So we have a total risk of $65 here. So I would be looking to, on all these trades, I'm looking to make it $50 to $100 to 150, somewhere in that range. If we pop down here, you can see we're up. This is going to be even bigger on the opening day, on the opening morning tomorrow. But I'm looking to make 50 to 100 to 150 bucks on this. So even if I let this thing go to expiration and lose the full 65 on a day when it rips, that's basically a 1-to-1 risk to reward ratio. And if we win more times than we're losing on these, that's a winning trade. And it's a great trade, especially if all you're doing is sleeping and dreaming of strawberry fields. So if we put on the hedge, let's take a look at the hedge real quick. So now the risk is 75. So in this case, if you want to be a stickler, you would try to get $75 out of this profit, at least $75 or more, just to make that a 1-to-1 risk reward ratio. If you want to make it a 2-to-1, you could even get out earlier. I think the majority of the time we're going to wind up in this range in the morning. But as we all know, anything can happen, and the market can crush your dreams. Anyway, that's just kind of like money management stuff for this, which I should probably do just its own video on. So, but let's go back to our scenario where we have this on at 5 times. So we have 5 there, 10. So it's a 5 by 10. So in this case, worst case scenario, if it expires here, anywhere from here all the way up, we have $325 worth of risk. The downside, we have $2,825 worth of risk. Now let's put our hedge on. Same hedge we did before, but let's do it 5 times because this is a 5 contract trade. So here it is with the hedge. Now, worst case scenario from here all the way up, if we let it expire at end of day, is $375 worth of risk. Here, it's $375 worth of risk. Here, in this hole, it's $2,875, but that's really, I mean, as far as margin goes, the broker's probably going to require you to have that in there to make this trade, but that's not a real risk. That's not something that I'm afraid of actually realizing that risk if I'm like conscious during the day and I can monitor this trade. You can see how the pink line is floating beautifully above it. At this point, the pink line right above it, you could make $472. And that's just going to continue to raise throughout the day. This pink line is not going to cave into this at all. It's going to stay at least above this hard blue line of 375 throughout the majority of the day. This thing will start to droop towards the very end of the day because this pink line is going to start to transform into this blue line. And so the pink line will be coming way up here, and then it'll start to droop a little bit into here, like maybe with 2 hours, 1 hour left. And by the end of the day, like maybe with 30 minutes left, it'll still be like probably like that. But I'm just explaining how we don't have to worry about that. I would never let it even go that far. I would totally get out of this trade. If we come down here and we're hovering outside the tent, I can make $470. I'm going to get out at that point, if not before. So I'm saying all that just to say, well, this is technically real risk. It's not realistically real risk unless you're just asleep at the wheel, don't do anything, and just let the thing expire, and the SPX somehow winds up expiring right in this area. Okay, so here's the main trade with the hedge. Now, so how can we boost this up so that worst case scenario, if it just starts to rip to the upside or it gaps way up, it's not as painful as $375, which is still a 1-to-1 risk reward ratio, so it's not that bad anyway. But if I wanted to raise that up and start to eliminate that, what would I do? I wouldn't, in this case, I would forget the XSP. I would just go straight to the SPX because we have a bigger position. So let's go to the SPX, and what strike do we want to start with? 6450. 6450s right here. Vertical. So there's one at starting right there at the same long. So this long right here on the initial position is at 6450. So if we were to buy a call debit spread at 6450, you can see that this now raises this up. Now there's $245 worth of risk. There's less. Then without it, there's $375 worth of risk. With one, there's now $245 all the way up. We could do two. Two would bring us up to, there's $115 worth of risk. We still have a nice bow going on, not as juicy as this one, but it's still reasonably nice. That would make us money. So now with the two there, we're at $115 worth of risk. Let's put three on. We do three, we're at $15 worth of profit. So now it's break even. There's really no risk to the upside from here all the way up. We've eliminated it. But again, we've brought the total profit potential down. But as I said before, I'm not necessarily looking to, I don't need all that. I'm just looking to make 50 times 5, 250 to $500 on this. And we have plenty of room to do that. It does flatten this out with this many. So we're paying for that protection. We have $15 worth of profit, so we have no risk to the upside, but we're paying for it. And we may have to wait longer for this pink line to bow up enough to give us the profit we're looking for the next day, and also falls off sooner. We get into risk. If there's a down move with this setup, we start to get into risk here-ish, where without it, we don't get into risk on the downside till way down here. Let's take a look if we just had two. So two, we've reduced it to $115. Our bow is okay. And we don't really get into risk until this one standard deviation line. So again, it's the same thing. It's just a matter of seeing what you're comfortable with and playing with the strikes and the different spreads to come up with a combination that suits you. But I wouldn't necessarily try to overdo this. Maybe if the next day, if we did gap up and we moved and we started to move up, maybe at that point look at buying another one, maybe to boost it up. Which at that point, that would basically just be a look mono hands trade. We would convert it into a look mono hands trade and just start to play the spread to the upside, and that would definitely start to boost it up. Okay, So that's that. That's how I would deal with the risk to the upside. Now, I'm not saying that I don't always do this, and you don't have to. This trade by itself, without any boost to the upside, in most cases, I believe should work out, should be fine, and you have a lot of room, even though it doesn't show it right here. In the morning, this thing is gonna, this pink line will expand. And like I said before, I've found that usually like a 10 to 20 point, this can handle a 10 to 20 point gap move or quick run up move in the morning to the upside and still be break even or profitable. Beyond 30 points, 40, 50, and then running off, that's when it becomes an issue. And even then, at days, it'll come back. So that's something to remember and take into consideration. And the final thing to take into consideration is, even if we do take the full loss, the $375 loss, depending on what you set as your profit target, this could be a 1-to-1 risk-reward ratio trade, and the majority of which you're going to win, and that'll just be one of the losers, which is totally in line with a profitable strategy. Okay, so that's that. That's how I would deal with looking to raise the upside risk, eliminating it or reducing it down to like a break even, or even putting it into a profit.